Welcome to Chapter 4, Gross Income from Personal and Investment Activities. In this section, we'll break down the essentials of income tax planning, focusing on how both personal earnings and investment returns shape your overall financial outlook. With insights from experts Thomas P. Langdon, E. Vance Grange, and Michael A. Dalton, this chapter will clarify how understanding gross income lays the groundwork for effective tax strategies. Let's dive into the building blocks of taxable income and explore what truly counts toward your bottom line. Ever wondered how your total income gets transformed into your actual tax bill? The federal income tax formula lays out each step. You start with all sources of income, subtract exclusions, and arrive at gross income. Next, deductions for adjusted gross income, known as the line, further refine your number. After itemized or standard deductions, plus special rules for things like qualified business income, you reach taxable income. Only then are credits applied, resulting in the final tax due or refund. Let's preview what's ahead. This chapter explores when income is taxed, including key concepts like the tax year, accounting methods, and the difference between realization and recognition. We'll also break down sources of income from both investment and personal activities, explaining what's included and what's excluded in each category. By understanding these fundamentals, you'll see why knowing both streams is essential for sound tax planning and maximizing your after-tax wealth. What exactly is a taxable year? For most people, it simply means a calendar year, January through December. But did you know some taxpayers choose a fiscal year, or even a specialized 52 to 53 week year ending on a certain weekday? The choice depends on your records and business structure. Knowing your taxable year is crucial because it determines when your income and deductions are counted for tax purposes, which can have a real impact on your planning. How you track income matters just as much as when you earn it. Cash basis taxpayers, often individuals and small businesses, recognize income only when it's actually received. Accrual basis taxpayers, typically larger businesses, count income when it's earned, even if payment comes later. And if inventory plays a big role in your operations, a hybrid method may be used. Choosing the right accounting method helps ensure your financial picture matches reality for tax reporting. Realization and recognition. What's the difference? Realization happens when you actually receive money or when a gain from selling property becomes fixed. Recognition is the step where that gain is reported on your tax return. While most realized gains must be recognized, there are exceptions that can defer or exclude certain gains from taxation. Understanding this distinction is key to knowing when income affects your taxes and how smart timing can benefit your overall strategy. Let's start by clarifying when income is actually recognized for tax purposes. Tax law follows the realization principle, meaning income is taxed only when it's realized, when there's a measurable increase in wealth. For example, if your investments rise in value but you haven't sold them yet, that gain isn't taxed until you cash out. Congress also defines what counts as income and even excludes certain increases in wealth from taxation. Understanding these distinctions is fundamental to accurate tax planning. Income recognition isn't limited to cash. You're also taxed on value received in kind, such as property or services, and even barter transactions. But here's a key exception. Recovering your original investment, like your initial deposit in a savings account, isn't considered taxable income. That's called the capital recovery doctrine. Recognizing both what counts as income and what doesn't ensures you don't overstate your taxable earnings, which is crucial for effective tax planning. Income can come from many sources, and understanding each type matters for your taxes. Investment income, like dividends or interest, is taxed to the owner based on the doctrine of the fruit and the tree. Employment income, think wages or self-employment, gets taxed to the earner. There's also personal activity income, such as alimony from pre-2019 divorces. Knowing where your income comes from helps you apply the right rules and avoid costly mistakes during tax season. If you live in a community property state, income earned by either spouse is typically split equally. This means half of all earnings belong to each spouse, similar to filing jointly for taxes. When spouses file separately, community property income is still divided evenly, which can complicate matters if they aren't cooperating. Understanding these rules is vital, not just for accurate filing, but also for avoiding disputes or errors that could trigger IRS scrutiny. Investment activities generate a wide range of income types. Capital gains when you sell assets at a profit, interest from savings or bonds, dividends from stocks, rental and royalty payments, and distributions from annuities or IRAs. Even more complex streams like partnerships or trusts are included. Recognizing all these sources is crucial because each may be taxed differently and may have unique reporting requirements. Missing one could mean underreporting your gross income, leading to penalties. Capital gains are taxed at different rates depending on your filing status and total gains. For instance, in 2025, married couples filing jointly hit the 15% rate at $96,700 of gains and the 20% rate at $650. Single filers see these breakpoints at $48,350 and $533,400 respectively. Estates and trusts have much lower thresholds. Knowing these brackets helps you plan asset sales strategically and avoid moving into higher tax rates unexpectedly. Not all capital gains are taxed the same way. Collectibles face a higher rate of 28%, while unrecaptured Section 1250 gains, often tied to real estate depreciation, are taxed at 25%. Plus, capital gains can push up your adjusted gross income, triggering phase-outs for other tax benefits. And don't forget, there's an extra 3.8% Medicare tax on investment income for higher earners due to the Affordable Care Act. These details make careful planning essential. Original issue discount, or OID, is a key concept when it comes to understanding how interest income is taxed on certain bonds. Under the doctrine of constructive receipt, taxpayers must recognize imputed interest every year, even if they don't actually receive any cash until maturity. The OID itself is calculated by subtracting the purchase price from the bond's maturity value. Each year, the recognized interest reduces the OID and increases the taxpayer's basis in the bond. But did you know there are exceptions? Series E and EE savings bonds are treated differently under the tax code, so not all bonds follow these rules. Recognizing OID ensures that taxable income accurately reflects economic gain, which is vital for proper tax planning. Let's bring OID to life with a practical example. Imagine Goldilocks purchases a 30-year zero-coupon government bond at the start of the year, paying $99.38 with an 8% market rate. Even though no interest is paid out annually, she's required to report $7.95 as interest income this year, calculated by multiplying her investment by the rate. By year end, her basis in the bond increases to $107.33. This annual recognition of interest is crucial for reporting investment income correctly, showing how seemingly simple investments can impact your taxable income year after year. Gifting a debt instrument introduces unique tax challenges. Both the giver, the donor, and the recipient, the donee, must report interest income based on how many days they each held the instrument, not just who ultimately receives the payment. But that's not all. These gifts can trigger additional taxes like gift, estate, or even generation-skipping transfer taxes. Understanding these rules helps prevent surprises at tax time and highlights why tracking holding periods and transfer details is essential for accurate tax reporting and effective financial planning. Dividends represent a classic form of investment income. Corporations distribute earnings to their shareholders, and these payouts are generally taxable up to the amount of corporate earnings. If distributions exceed those earnings, the extra is first treated as a return of your original investment, then as a capital gain. Qualified dividends are taxed more favorably, following the capital gains rate table, but only if paid by eligible corporations and if you meet certain holding period requirements. And here's an important reminder. There's an additional 3.8% Medicare tax under the Affordable Care Act that could apply to your dividend income. When it comes to annuities, understanding how much of each payment is taxable hinges on the exclusion ratio. Simply put, it's your investment in the contract, divided by the expected return, multiplied by distributions received. For contracts starting after December 31st, 1986, you can never exclude more than you invested. Any unrecovered investment gets deducted on your final tax return. Withdrawals before age 59.5 typically face a 10% early penalty, unless you qualify for exceptions like death or disability. And before annuitization, payouts are taxed using a last-in, first-out method. Life insurance policies have their own set of tax rules. If you receive a payout from an endowment contract before death, it counts as taxable income. Surrendering a policy, the difference between what you receive and your basis, is also taxable. However, death benefits are usually excluded from gross income, unless the transfer for value rule applies, which can make them taxable in some cases. These distinctions are critical for understanding how different life insurance events impact your overall tax liability and financial planning strategy. IRAs bring another layer to gross income planning. Generally, distributions are taxed as ordinary income, but there are important exceptions. Returns of basis, amounts calculated using an exclusion ratio, and Roth IRAs, which are usually excluded from income altogether. Penalties can add up quickly. Withdraw too early and face a 10% hit. Contribute too much and it's a 6% penalty. Delay required distributions and penalties jump to as high as 25%. Thanks to Secure 2.0 Act changes after December 29, 2022, that late penalty has been reduced if corrected promptly, a crucial update for staying compliant. Let's explore how business entities impact gross income, especially when it comes to pass-through entities like partnerships, LLCs, and S corporations. In these setups, income isn't taxed at the business level. Instead, it flows directly to owners based on their ownership percentage. This means your share of profits, losses, and even certain adjustments can affect your personal tax liability. As you recognize income from these entities, your basis or investment increases, influencing future tax calculations and planning. When it comes to estates and trusts, income tax rates can escalate quickly. For 2025, the first $3,150 is taxed at 10%. If taxable income exceeds $3,150 but stays below $11,450, you'll owe $315 plus 24% of the excess. Higher brackets jump to 35% or even 37% for amounts over $15,650. Understanding these tiers is vital for proper tax planning. Small changes in income can lead to significant increases in tax owed for these entities. Virtual currency isn't just a digital trend. It's treated as a capital asset for tax purposes. Any sale or exchange can result in a taxable gain or loss that must be reported. If you use virtual currency to buy something, calculate your gain or loss by subtracting your basis from the fair market value of the purchase. And starting January 1st, 2025, gross proceeds from these transactions must be reported on Form 1099-DA, adding another layer of compliance for taxpayers. Not all investment income makes its way into your gross income calculation. For example, interest from municipal bonds is often excluded, though there are some exceptions. Life insurance death benefits are generally exempt, as are certain accelerated benefits for the terminally or chronically ill. Roth IRA distributions, education-related exclusions like qualified tuition programs, and even tenant improvements to landlord property may also escape taxation. Knowing these exclusions helps maximize your after-tax wealth. Municipal bond interest offers a unique tax break. It's generally exempt from federal taxes and may also be excluded from state taxes. However, keep in mind that any capital gains from selling municipal bonds are still taxable. To compare these bonds with taxable investments, use the tax equivalent yield formula. Divide the tax-free rate by 1 minus your marginal tax rate. This calculation helps you see the real after-tax return and make smarter investment decisions. Life insurance offers several tax advantages. Death benefits paid upon the insured's passing are typically exempt from income tax, except in cases where the transfer for value rule applies. When you take distributions from a regular policy, they're first treated as a return of your basis, then as loans. Modified endowment contracts follow a last-in, first-out rule, meaning distributions are taxable up to the amount of gain. Accelerated death benefits may also be excluded if the insured is terminally or chronically ill. Roth IRAs stand out because contributions aren't deductible now, but qualified distributions are completely tax-free. To qualify, you must satisfy the 5-year rule and meet conditions like reaching age 59 and a half, experiencing death or disability, or making a first-time home purchase up to $10,000. Roth IRAs use FIFO treatment. Withdrawals come from your contributions first, ensuring those distributions are always tax and penalty-free, making Roths a powerful tool for long-term planning. Let's begin by exploring the savings bond interest income exclusion, a key education exclusion for taxpayers. To qualify, you'll need U.S. Series E bonds issued after December 31st, 1989 in your name or your spouse's, and you must be at least 24 years old when the bond is issued. But here's the catch. This exclusion phases out at higher incomes. For joint filers in 2025, the phase-out starts at $149,250 and ends at $179,000. For others, it ranges from $99,000 to $104,500. Understanding these thresholds helps families plan ahead to maximize tax-free savings for education. Next up, 529 plans. These powerful savings vehicles offer tax-free distributions when used for qualified education expenses. Think tuition, books, or room and board. Sponsored by states or educational institutions, 529 plans also allow you to front-load gifts. In 2025, a donor can contribute up to $95,000 per beneficiary by using 5 years' worth of annual exclusions at once. And there's more. Unlike many other accounts, there are no income phase-outs. That means anyone can take advantage of these plans to save for future education costs. Coverdell Education Savings Accounts are another popular tool for tax-advantaged education savings. You can contribute up to $2,000 per year until the beneficiary turns 18. Withdrawals are tax-free if used for qualified educational expenses, including elementary and secondary school costs, special needs services, or even rolling over funds to a 529 plan. However, there's an important deadline. The account must be used or rolled over by the time the beneficiary reaches age 30. Planning ahead ensures you get the full benefit from these accounts. But what about income limits for Coverdell contributions? Here's where phase-outs come into play. If you're married filing jointly, your ability to contribute starts phasing out at $190,000 of income and cuts off completely at $220,000. For all other filers, the range is $95,000 to $110,000. Staying aware of these thresholds is crucial. Contributing above them can mean reduced or disallowed contributions. Knowing your eligibility helps ensure your saving strategy aligns with IRS rules and avoids unexpected surprises. Let's see how these phase-outs work in practice. Take Ziggy and Marley, married filing jointly with an AGI of $200,500. They want to contribute to a Coverdell account for their son, but are within the phase-out range. Using the formula, $2,000 times the portion of income over $190,000 divided by the $30,000 range, their allowed contribution drops by $700. That means instead of the full $2,000, they can contribute only $1,300 this year. Calculating reductions like this ensures compliance and helps maximize every available dollar for education. Personal activities generate many forms of taxable income beyond just wages. Consider prizes and awards. These count as income. Alimony from divorces finalized before 2019 is included as well. Discharge of indebtedness can create taxable income if debt is forgiven. Payment apps and online marketplaces now report income more frequently. Even imputed interest on below-market loans is taxable. Other categories include gambling winnings, jury duty fees, executor fees, and hobby income, all vital to remember when calculating your total gross income for tax planning. Prizes and awards typically must be included in your gross income, but there are exceptions worth noting. If a prize is paid directly to charity at your request and recognizes achievements in fields like science or the arts, and you didn't apply or provide substantial future services, it may be excluded from income. Employee Achievement Awards also have exclusions, up to $400 per award and a total of $1,600 annually if they're tangible personal property. Recognizing these exceptions can help reduce your taxable income while rewarding excellence. When it comes to payments made to former spouses, tax rules vary based on the timing and type of payment. Alimony under divorce decrees entered into before December 31, 2018, is deductible for the payer and taxable to the recipient. But for decrees after that date or those substantially modified later, there's no deduction for the payer and no tax for the payee. Child support and property settlements, regardless of timing, aren't deductible at all. Knowing these distinctions is vital for tax planning during divorce. But what exactly counts as alimony? For a payment to qualify, it must be in cash and specified by a divorce or separation agreement that doesn't label it as something else. The ex-spouses can't live in the same household. Payments must end if the recipient dies, and it can't apply to couples still filing jointly. These criteria ensure that only genuine, court-ordered support fits the IRS definition of alimony, which is key when determining your taxable income. Not every payment between ex-spouses is considered alimony. Elective payments that don't meet alimony criteria, child support, and even letting a former spouse live in your home rent-free are excluded. In fact, any payment that drops when a child reaches a certain age is automatically treated as child support for tax purposes. Recognizing what isn't alimony helps prevent tax surprises and ensures accurate reporting of gross income. Let's bring this to life with an example. Suppose Hector's divorce decree, entered before 2019, requires $5,000 monthly payments to Lydia. When their child Tuco turns 18, payments drop to $3,000 per month. Here's the key insight. $2,000 is classified as child support because it stops when Tuco reaches a milestone tied to his age. The remaining $3,000 is true alimony. This split impacts both taxation and deductions. Property settlements during divorce are handled differently. When spouses transfer property as part of a settlement, there's no immediate income tax deduction or recognized gain or loss. Instead, the transfer is treated like a gift under the tax code, meaning the recipient keeps the original cost basis of the asset. Understanding this carryover basis is essential for future tax planning, especially if that property is later sold at a gain or loss. Divorce settlements can raise special issues with insurance. If medical insurance payments aren't clearly designated as child support, they're treated entirely as alimony. For life insurance, who owns the policy matters. If the recipient spouse owns it and premiums are paid by the other spouse, those premiums count as alimony. But if the recipient is just named beneficiary, premiums don't count as alimony, though death benefits are tax-free and may affect estate taxes. Finally, let's talk about debt forgiveness, often called discharge of indebtedness. When a lender forgives debt and you're solvent, that amount usually counts as income and increases your gross income. However, there are notable exceptions. Certain student loans, debts forgiven as gifts, or qualified principal residence indebtedness discharged before January 1, 2026. Understanding these exceptions helps you accurately calculate your taxable income and avoid costly surprises down the road. Let's talk about income from payment apps and online marketplaces. When you receive money for goods or services through platforms like Cash App, PayPal, or Venmo, that income is taxable, even if it feels informal. Starting in 2024, providers report transactions over $5,000, dropping to $2,500 in 2025, and just $600 in 2026. But not everything counts. Gifts or reimbursements aren't taxable if you indicate non-business in the app. Understanding these rules helps you avoid tax surprises. Ever heard of imputed interest rules? Imagine lending money to a friend with little or no interest. The IRS treats this differently than a regular loan. In fact, both the lender and borrower may face tax consequences even if no cash interest changes hands. This cartoon scene illustrates how money flows between lender and borrower, reminding us that even informal loans can carry hidden tax implications. Knowing these rules is essential for smart financial planning. Let's break down how the IRS handles below-market loans. If a lender gives an interest-free loan, say, a parent to a child, the IRS may require the lender to report imputed interest as income, even if no payment was actually received. Meanwhile, the borrower could get an interest deduction. This flow of imputed interest and principal repayment means that even 0% demand loans can trigger tax responsibilities for both parties. It's a key consideration in family and business lending. Continuing with below-market loans, the IRS also considers the idea of a gift of interest. When a lender charges 0% on a demand loan, part of what isn't paid back as interest is treated as a gift for tax purposes. The borrower's imputed interest and principal repayments still count, but the lender might need to report a gift of interest payment. This highlights why understanding the tax treatment of personal loans is so important for avoiding unexpected tax outcomes. Below-market loans don't just apply to families, they're common in businesses too. When a corporation lends money to a shareholder at below-market rates, the IRS may treat part of that loan as a dividend. For employees, it could be considered extra compensation, subject to employment taxes and not deductible by the employee. In both cases, any interest returned is taxable to the employer. These distinctions are crucial for accurate tax reporting and smart business structuring. So when do below-market loan rules apply? They kick in for term or demand loans that qualify as gift loans, like those made between family members, or when the loan is used for tax avoidance purposes. Recognizing which loans fall under these rules ensures you don't overlook potential tax liabilities. Whether you're lending to help someone out or for business reasons, knowing these boundaries can save you from costly mistakes during tax season. Not every small loan triggers imputed interest. Thanks to de minimis exceptions, if your loan is $10,000 or less and isn't used for income-producing assets, there's no imputed interest. For loans up to $100,000, imputed interest depends on the borrower's net investment income or a calculation based on federal rates. If net investment income is under $1,000, there's no imputed interest at all. Only larger loans above $100,000 follow strict IRS calculations. Let's talk about the tax benefit rule, a fundamental concept for anyone managing deductions and refunds. Imagine you claim a tax deduction for an expense this year, then receive a refund or reimbursement for part or all of that expense in a later year. What happens next? The answer: the amount you recover must be added back into your gross income, but only up to the benefit you gained from that deduction. This ensures fairness in tax reporting and prevents double dipping. Personal source income isn't just about wages or salaries. Have you ever won money gambling, earned fees for jury duty, or served as an executor of someone's estate? Even income from a favorite hobby can be taxable. Each of these is considered personal source income and must be reported. Knowing these less obvious sources helps ensure you don't overlook taxable income when planning or filing your taxes, an essential detail for both individuals and professionals. Not all personal receipts count as taxable income. Think about gifts, inheritances, or scholarships. These are among the 10 major exclusions from gross income. Others include child support, property settlements, certain insurance payments, qualified foster care payments, and even some disaster relief. Why do these matter? Recognizing these exclusions lets you avoid over-reporting income, streamlining your tax return, and keeping more of what's rightfully yours. Scholarships can be a huge financial help, and the good news is, many are excluded from taxable income. If you're pursuing a degree at an eligible institution and use your scholarship for tuition, fees, books, supplies, or equipment, it's generally not taxable. Qualified tuition reductions and Pell Grants are also excluded from income. This means more educational assistance stays in your pocket, supporting your studies without creating a tax burden. Qualified charitable distributions, known as QCDs, from IRAs offer a unique tax advantage. If you're age 70 and a half or older and have your IRA trustee pay a distribution directly to a qualified charity, that amount can be excluded from your taxable income. It's reported on Form 1099-R and shown as zero taxable on Form 1040. Remember, QCDs apply only to IRAs, not to 401ks or other retirement plans. Qualified disaster relief payments provide crucial support during challenging times, and many of these payments are excluded from gross income. Covered expenses include reasonable living costs, repairs to your home or belongings, funeral expenses, and welfare support. These exclusions apply if the payment follows a presidentially declared disaster, terroristic action, military event, or accidents involving common carriers. Understanding these rules helps you avoid unnecessary tax on much-needed aid. Compensation for injuries and sickness has its own set of inclusion and exclusion rules. For example, damages received for bodily injury are typically excluded from gross income if they're compensatory, but punitive damages are always included. Compensation for personal injuries not involving bodily harm, lost income, or any other injury is generally taxable. Understanding this table is key to correctly reporting settlements and ensuring you comply with tax law.